Welcome, everybody, to the third installment of Collective's Insight Series. I'm Greg Brager, the CEO of Collective. In these webinars, we try to bring to our community some unique analysis on trends and topics concerning the late-stage venture asset class. And today, we will be discussing the current investment environment. There's a lot going on. And to lead that conversation, we're very pleased to have with us Mr. Ankit Misra. Ankit recently joined Collective as our Chief Investment Officer from JPMorgan Chase, where he was responsible for strategic investments. Ankit, take it away.
Great. Well, thanks for having me, Greg, and I'm super excited to be here at Collective. The team is building a valuable product for the startup ecosystem, and I'm glad to be a part of that journey. I think as folks join in, we didn't plan to have the webinar right today as the Fed decides on the size of the rate cuts after 4 years of pause, entering a new era of monetary policy, but interesting to see where it all lands tomorrow afternoon.
Momentous day. So I'm not seeing the screen, but I think today we're talking about three primary topics, Ankit. One, the general economic environment, whether it's favorable to investors and how that will be impacted by Fed rate cuts. I think we'll also talk about what we're seeing in the public equities market, obviously always relevant to what's happening in the venture world. And finally, what trends are we seeing specifically in late-stage venture?
I think to kick off the first one around just a generic economic outlook and broader market sentiment, especially with the Fed rate cuts around the corner, is it going to be better for consumers and investors? And I think it's really hard to predict the exact interplay of various market forces. But one thing is clear, that markets will continue to be volatile. If I were to use the traditional airplane analogy, I think the economy still faces strong headwinds on one hand, which includes unsustainable level of US government spending, also depletion of all the excess consumer savings accumulated during the pandemic, and also global forces like deglobalization and geopolitical tensions. So that's on one hand. And then on the other hand, you have supporting tailwinds from the anticipated rate cuts. Also, more importantly, continued innovation, boosting the productivity of the economy. So those are your headwinds and the tailwinds. And you also have what I call turbulence, which is caused by amplification of volatility because of increasingly connected markets and automated markets. I think that particular point, many market participants underestimate that the level of technology penetration in markets has increased tremendously, and what unintended consequences it may have. For example, the algo trading is estimated to be, I think, 60% plus of the entire stock market activity in the US.
Wow.
And it amplifies market reaction to events such as the yen carry trade that we saw in July, or the SVB collapse within 36 hours. I think that aspect of market volatility is sometimes not considered when we think about how quickly things could change. But look, time will tell whether it's going to be a soft landing or not. But it's prudent for investors to be prepared for a variety of outcomes, including potentially a stagflation era as well. With that said, on the broader economy, I did want to share two interesting charts, which caught my eye. This one is interesting analysis of the government spending, which has led to debt levels not seen since the World War II. And more importantly, no path to recovery in the near term. It's just remarkable that US is spending more on servicing its debt than on national defense. And how much longer could we continue to add $1 trillion in debt every 100 days? It remains an open question. So this is the chart I was referring to when I was saying that the US national debt as a percentage of GDP has not been this high since the World War II, and how sustainable that continued spending could be The other interesting takeaway of the spending is also the extent of the impact it has on the GDP growth. So for reference, last year, US spent about $1.7 trillion more than its revenue. And this deficit represents close to 6% of the GDP. And compare that to the GDP growth rate of 2.5%. A roundabout way of saying, if government was to spend within its means, you probably don't have the GDP growth that we claim to have, right? So I think it just centers the point around that government spending is a key driver of GDP growth, whereas I feel sustainable growth in the economy has to eventually come from productivity improvements and not excess government spending. And this is where I feel the continued AI innovation will be critical in coming years as a source of increasing that productivity.
Makes sense.
And just checking, Greg, are you able to see this chart? Sometimes it times out. Okay, perfect. So the other point that we touched upon was how the excess household savings that were accumulated during the pandemic era because of all the government stimulus have eventually depleted. And now the consumer demand is somewhat wavering. And we all heard about the Airbnb lowering its guidance on demand because of softening that they see in the consumer. So that's another sort of headwinds that I talked about in my airplane analogy. Then I think the second point is really about, as you said, Greg, what are we seeing when it comes to public equities markets? And over there, I think the first point to make is really around what has happening to the valuation multiples, because I think we all saw a golden era of zero interest rate period leading up to super high valuation multiples, which we all in the investor community thought were unsustainable. Rounds were getting done in days, sometimes a couple of days, and if not that, at least getting as quickly as in weeks. And then from that peak of the market in 2000 or 2020 to 21, seeing a market-wide correction subsequently, arguably overcorrection in certain segments. But eventually where we are today, I feel is a reversion to historical averages. And I think one can argue that public markets have appeared to be reverted to a reasonably priced averages now. The other point to see on this chart is also that growth is still valued. I think there was definitely a change in perception of growth, away from growth at all costs to growth measured with profitability. But I think still you see over here there is definitely a very strong premium for high growth companies. So over here we see high growth is something that's growing more than 30%, and it's been trading at much higher multiples, like an average of 9.4 times as compared to low growth companies, which in this chart is less than 15%, and they trade at much lower multiple, 3.3. So I think net, it's great to see that public equities have reverted to historical averages. It's still reassuring to see that there is a premium for growth, even though it has to be measured by profitability.
And Ankit, what do you think drives the greater multiples for the larger market cap companies? Is it that they are growing at a higher rate, or is it something different?
Yeah, I think this one is purely that on an NPM basis or 2-year forward basis, if you are growing faster, your implied multiple a couple of years down the line is actually lower. So it's really adjusting for growth. I think the other part that you're alluding to, we'll touch upon, is how is this market cap distributed in equities market, right? And it seems to be fairly concentrated in the top 10 names, and what are the drivers for that?
Yeah.
So maybe I do jump to that aspect first, and then I'll come back to these multiples. So this is a very interesting chart, and I think What it shows in a sense is that the concentration of market cap is at an all-time high. If you go back all the way since like 1950, then that's a very compelling takeaway. And I think we all had a sense that the big is getting bigger, but the extent of concentration is simply staggering.
Yeah.
And then the point that you raised, Greg, that the concentration that we see in the top 10 names is not really commensurate with the earning distributions, meaning it's really the multiple expansion of the top 10 names, which is actually leading up to this, 31% of the market cap being concentrated into top 10 names, as opposed to their earnings actually becoming commensurately bigger. And that I think is partly because of, in market correction times, there's a flight to quality, and people want to go with established companies with which have enough runway and growth prospects, and that leads to natural concentration into established and bigger companies as opposed to arguably riskier subscale companies. So I think that also is something which is driving the concentration here.
And of that top 10, what percentage of those companies roughly do you think are technology companies, the Microsofts and the Apples and such?
I would say a majority, if not super majority of them are technology companies, which is an increasing trend.
Yeah.
And then we probably continue to see that, especially as the AI innovation wave picks up and people sort of embrace that. And we've already seen that the big tech companies are very well positioned to benefit from that as an infrastructure provider. But I think there's something to be said about what to expect after these peak level of concentrations. And that's the other chart I have in here, where you see on the left side on a multi-year build up to peak level of concentrations. And here we have slightly different metrics. We are looking at Russell 1000 versus Russell 2000. But looking at, for example, what happened in the 1900s and how peak concentrations and large cap were similar over a multi-year build-up, but then subsequently it led to a strong rotation into small cap, and small caps actually out delivering the large caps, right? So that's, many analysts would argue that we are on the cusp of that rotation, and in fact we witnessed somewhat of that rotation very briefly in July, where that's the chart you see that was published in journal, where for a couple of weeks in July you see Russell 2000 appreciating vis-a-vis almost all of the top 5 companies depreciating during the same period. So sort of like the same rotation that we're talking about. I think it was a little short-lived because there's still this, sentiment of flight to quality. There are a lot of economics uncertainties around the corner, be it like the Fed interest rates cut back, the size of it, the timing of it. Also, the elections and the geopolitical tensions. So there may still be some stickiness to the quality assets, but I think it's a matter of time where it's going to be more widespread than it is today.
Well, it does seem as though a reversal in the direction of interest rates, which we're expecting, almost certain of tomorrow, would be a real catalyst for an acceleration of this trend.
Yeah. Okay, so I think the last point I'll make on the public equities, and then we should switch gears to private markets, because that's where we as Collective operate and focus on. I think this has been a topic which a lot of our investors have been asking us routinely around what's happening in the IPO markets, when do we expect the window to reopen. And I think, so I sort of put together these charts and an analysis from other research houses. And if you look at it, 2024, I think has been a reasonable year already, especially when it compared to 2022 and 2023. But having said that, I think there's no denying that we got to embrace the new normal here. We're not going to see the 2021 level of activity anytime soon, and maybe never again. And I think that's particularly in context of, while the public markets, already listed companies reverted to historical averages, I think private companies have this inertia, if you may, because you had all these pre-IPO investors who invested in this company at peak valuations in the 2021 timeframe, and they would want the company to grow into their valuation to at least return their capital, right? So I think that's the inertia, which is not just about whether investors in public equity markets are there already in terms of reallocating to that asset. It's also about the supply of companies and what does it take for pre-IPO investors to make money. So I think that's important dynamics, which sort of distinguishes the pre-IPO market vis-a-vis the post-listing public equities.
Interesting. Yeah.
Having said that, I would say, look, there is meaningful demand for such companies that are priced appropriately and have strong management, durable business models, and long-term growth prospects. I think the volumes year to date in 2024 speaks for it. There's I think half a dozen S1s already filed, including some tech companies like Turo. So that is, I think, reasonable pipeline.
Well, and I would think, I'd certainly defer to you, but I would think just on your point of the supply side of companies wanting to go public is an important part of just how wide the window opens and when. Given the kind of numbers that we've seen here in 2022, 23, 24, and similar decrease in the amount of capital raised by these very late stage venture-backed companies, I would assume that there's growing pressure on these companies to get public, either for capital raising purposes or to provide liquidity. And I guess, as you said, it's, the valuations for what are currently private pre-IPO companies are something of a challenge, particularly if they last priced in 2021 at a multiple that's not sustainable in the market today. And there is always inertia. I think these boards want to, hope that something really good happens really quickly. But at some point, the dawning realization is that was a real outlier year. And as you say, we're kind of getting back to the new normal or the old normal.
Yeah, exactly. And the other thing I'd also say is that it's not just the volume. I think for volumes to hold up, you need to see strong performance of those IPOs. Otherwise, it's something like SPAC, which has a lot of flash in the pan value. But if you don't have sustainable performance, then eventually the volumes go away. Yeah. And we did try to look at the IPO performance of all the companies that have gone public this year, and that day one performance has been like 9 to 14% average. I don't read too much into the highs, especially given our prior discussion around volatility due to external factors. But opening at 9 to 14%, currently trading at 11 to 17, so mid-teens kind of performance, and which I think is higher if you exclude some of the biotech kind of names which have their own idiosyncratic issues. I think it's reasonable performance. Having said that, look, this is still a little too early to declare victory because many of these companies still have lockups, and you really need to see the long-term performance before concluding that performance is robust and volumes are going to revert to pre-pandemic averages. But I think this is looking increasingly better and better, and it's fair to say that probably the bottom of the market is beyond us.
Right, behind us, yeah.
All right.
So Ankit, what trends as we now kind of shift to the private market, which, as you said, is our focus at Collective. What are you seeing in terms of market data, deal structures? What should we be looking at?
Yeah, so I would make 3 points here. One is it's really good to see that there is a now greater balance in private markets or secondary markets. And the way we sort of measure that is to look at the bid-ask ratios. If you look at what happened in 2022's, a lot of sellers were there, but not many buyers, and that sort of distorts price discovery and investor confidence. So I think seeing that bid-ask ratio stabilize is great for private markets, especially the secondary markets, both for, as I said, price discovery and investor confidence. And I think many institutional buy-side firms typically have like strict criteria around trading only on platforms with certain minimum level of liquidity. I think it's hard for them to, quote unquote, stream prices or, routinely do trades where the spreads are too high. So that's another reason why having, deep markets is actually helpful. So we do see a recovery in markets and from that perspective, and I think that's a great sign.
Well, and just before we turn the slide, I think one of the things to point out is that this is not an easy graph to put together because the private markets are so fragmented. And so I think it's sort of a unique advantage that we have at Collective, that we get marketplace data from so many different marketplaces, are able to aggregate it together and therefore get this kind of holistic view about what's happening, not just in one slice of the market, but across all of the kind of late stage trading venues.
Yeah, no, thanks for that. Our data team spent a lot of time integrating with all the vendors and aggregating it to present this insight, which is not a single dealer platform driven, but more representative of the broader market.
Yeah.
The other interesting trend I wanted to share with this group is around what's happening in the secondary markets from a structure perspective. So for background, historically a lot of trading in secondary markets happened directly, meaning the buyers and sellers were transacting directly, or instead of an outright sale, doing a forward kind of a structure, even though that was not as big proportion of the market. But what we have seen steadily is a shift towards SPV over the past 6 quarters. It's a very steady, clear shift, and sort of makes us wonder what's really happening here. But I think thinking about it from the investor and issuer perspective, I think this trend reflects increasing investor appetite to share economics for access to differentiated opportunities. And I think that's important because SPV structures typically reward the platforms for bringing the differentiated opportunities, and you're able to charge a fee on top of just a brokerage model. So I think that the fact that investors are choosing SPV structures over direct trades and willing to share economics is just reflective of their confidence in the secondary markets. And then thinking about it from an issuer perspective, I think having SPVs on the cap table, like one can argue that it streamlines the cap table and fewer sort of shareholders in the company, which is easier to manage. So I think net-net, it has value proposition both to investors and to the issuers. And, this trend, I think, is very encouraging because it speaks to the robustness of the secondary markets.
Yeah, makes sense.
And then this last slide I had, it's very interesting. It's from one of my, my prior employer. They run the secondary platform, and they share this data around the structure of deals that are happening in the private markets. And as evident on the chart, basically we see increasing structure, i.e., increasing liquidation preference and the prevalence of those structures in late stage venture deals. And it's really important because it's another distinction between public equities and private markets, right? We talked earlier about how public equities have reverted to historical averages when it comes to valuation multiples. But in private markets, the valuation, meaning the post-money valuation or the multiples alone, is not sufficient to analyze the attractiveness of an investment. You also need to consider, what are the structuring elements, especially liquidation preferences and whatnot. And this is, again, another aspect which we at Collective spend a lot of time on, trying to understand the cap tables, the structures they're in, and look at the company valuation in conjunction of not just the total value of the company, but also what could be the price of individual securities in the cap table, which often are highly structured. And based on this chart, that structuring is increasing over time.
Well, and just for maybe some of the members of the audience that are a little bit less familiar with this kind of the legal terms, or for example, liquidation preference, just to say or to add, this essentially enables the investors that come in the more recent rounds or the most recent round to insert in the company's charter provisions that mean that they get paid something more than the other investors were on a share per share basis. And so there's all different kinds of ways to structure it. But essentially at the exit, the share proceeds are not necessarily, or the sale proceeds are not necessarily distributed to everybody on the same amount per share, but sometimes, and increasingly since 2022, the venture capital, the institutional investors, as opposed to the common shareholders that are primarily the employees, are going to take a disproportionate amount of the sale proceeds. So, Ankit, to your point, it's critical, obviously, is particularly if you're a buyer of common shares or a holder of common shares, to understand these technical details that we spend so much time focusing on at Collective.
And I would say that's another way how private markets differ from public, in the sense that while correction in public equities is all about the listed price, the market valuation implied by the share price, right? And it's a very liquid marketplace, and that price sets the valuation of the company. The dynamics here, which is leading to increase in structuring, is somewhat similar to the pre-IPO dynamics that I talked about. Mm-hmm. Over here, I think all the people who have, paid really high valuation before, and then, now have to think about follow-on financing into the company, there is some reluctance to bring the mark down. Yeah. And while recognizing that the company is probably not worth as much as the last round. So what do? I think that's where the structuring comes into the picture, where the investors are trying to get other sources of return and not just the fully diluted ownership in the company. Mm-hmm. And that's another reason why you're seeing this structuring. I think valuations were high before. There is a inertia to maintain those because it's private markets. And the way to do that is to sort of, probably maintain the headline valuation, but offer other sources of returns to investors. And as an investor in private markets, you really need to be cognizant about those other drivers of return.
Makes sense. Yeah. So, Ankit, is that, so it seems like we've covered the slides and we're kind of getting close to the end of time, but let me just say, or let me just ask, if there's sort of one message that you'd like people to kind of take away from all these different slides and insights that you've shared with us, what would that be?
I would say at a big picture, I know Fed rates cuts are probably coming, but safe to say that volatility is probably here to stay. And in that environment, diversification will be the key. Mm-hmm. So if you have a diversified presence in equity markets over a long-term investment horizon, mm-hmm. that can deliver substantial value. And net, like time spent invested in the market is more important than time in the market. I think it's really hard to say which way it's going to go in the short term. Mm-hmm. But staying invested over a long period of time, over a diversified portfolio, that probably is the most prudent approach in the current environments. Makes sense. Okay. Well, thank you, Ankit. That's going to conclude today's webinar, and everyone will be receiving an email tomorrow, latest the next day, with a link to the video. So please feel free to share that with anyone you think might find it interesting. And we'll look forward to seeing you all back at the next webinar. Thanks so much. Bye-bye. Thank you.
Collective Liquidity. Free your wealth now.